In today's video, we're going to be doing something a little bit different than what I usually do on my channel. Instead of diving into one specific macro topic, I'm going to be doing a full market recap for the first half in the second quarter of 2026. This has been one of the strongest first halves that we've seen in the market for years, and I think it's worth taking a step back after such a great quarter and a half year to take a look at how different asset classes, styles, and geographies have performed. And now, while it may have been a great Q2 and H1, it is important to acknowledge that this was not a straight line up. There was lots of volatility. Things actually weren't looking too hot at the end of Q1. The S&P 500 had fallen 4.3% in the first quarter, which was its worst quarterly performance since Q1 of 2022. Then we had the Iran war break out in late February, and oil went from around $60 a barrel to over $100 by the end of Q1. To say the least, it was a messy start to the year, but as we will get into, Q2 brought on some of the strongest returns that we've seen in a long time. Let's start by laying out some numbers. For the full first half of 2026, the S&P 500 finished up about 9.6%. The Nasdaq Composite was up over 12%, and the Dow Jones was up just under 9%. Those are strong numbers on their own, but the numbers from Q2 specifically are what really stand out. The Nasdaq posted nearly a 20% gain in the second quarter, and which from what I can see was its best single quarter since Q2 of 2020. The S&P was up nearly 14% in Q2, and the Dow was up around 12.5%. As of right now, all three of these indices are sitting near record highs to close out the half. One of the more interesting stories of the year so far is the comparison between growth and value performance. Coming out of the gate in Q1, value stocks and small caps were outperforming growth stocks and large caps. Then Q2 came around and AI earnings exploded and growth came roaring back. Many thought that growth had come back to life and would overtake value and small caps, but as of the end of this quarter, on a year-to-date basis, value as measured through VTV is actually outperforming growth measured through VOOG. What I'm about to say connects directly to something I talked about in a previous video on this channel. The top 10 stocks in the S&P 500 right now make up about 39% of the entire index, with the top 3 alone accounting for nearly 21% of the total market cap. So when you buy a plain S&P 500 index fund, you're getting a portfolio that is almost 40% concentrated in 10 companies. What that means in practice is that the cap-weighted S&P and the equal-weighted version of that same index can tell very different stories. In Q1, equal weight was outperforming substantially as the mega cap names sold off and the rally broadened out. In Q2, cap weight funds came roaring back as the big tech names led again, and for the full half, equal weight actually won out just slightly. The reason why I bring this up is because this is usually a sign that the rally is becoming healthier and more broadly supported rather than being carried by just a handful of names. As I mentioned earlier, small caps had a very strong first half. IWM, which is the Russell 2000 ETF and is the most widely used small cap benchmark, finished up 17.6% for H1. And the reason for this outperformance is the fundamentals. The Russell 2000 is projected to deliver 43% year-over-year earnings growth in 2026, and that's according to Bloomberg consensus estimates, and these estimates vastly outweigh those for the S&P 500. Valuations are also cheaper, as small caps are trading at around 18.5 times forward earnings versus 23 times for large caps, and that nearly 5-point gap is historically wide. Right now, emerging markets are the biggest story in international markets as a whole. EM returned over 34% in 2025, which far surpassed the S&P 500's 18% return. This was actually the largest outperformance for emerging markets in 17 years, and that momentum carried into 2026, with the MSCI Emerging Markets Index up around 7% as of early February before the Middle East shock hit. Taiwan and South Korea are the standouts in emerging markets because they are directly benefiting from the AI semiconductor buildout. Valuations in EM are still historically cheap, even with this outperformance, and are trading at around 14 times forward earnings, which compared to the 20 plus times for US large caps is a meaningful discount. Also, there's potential dollar weakness in the second half that may act as a further tailwind for emerging markets as well. Let's touch on fixed income for a second. The Bloomberg US Aggregate Bond Index finished H1 roughly flat, and Q1 was pretty rough for bonds. The oil price spike renewed inflation fears, treasury yields rose across the curve, and having duration in a portfolio really hurt. The longer the bond, the more it sold off. And of course, there are many other catalysts for pain in the long end of the curve, like fiscal stability, record bond supply, and so on. But the short end of the curve has been very sensitive to the Warsh Fed uncertainty that I covered in the FOMC breakdown video. High yield corporate bonds have held up better than investment grade for most of the half, as credit spreads have stayed tight, and that's reflective of the strong earnings environment that we've seen. Municipal bonds, which I actually also talked about in a recent video, basically just tread water as a category. And with the stress that we went over, I think that's concentrated in specific issuers rather than the broad market. The real fixed income takeaway for H1 is that if you own shorter duration, higher quality paper, you're roughly flat to slightly positive. If you own long duration, you gave up some return. Now we are jumping back to equities to talk about earnings as a catalyst. Q2 2026 earnings growth for the S&P 500 is currently estimated at 23.1% year over year. At the start of the quarter, back in early April, the estimate was only 18.8%. So not only is earnings growth running at 23%, it is running 4 points above where analysts thought it would be at the start of the quarter. Historically, analysts tend to lower estimates during a quarter, not raise them. And so the fact that estimates went up is a real signal about how strong the underlying corporate results have been. For the full year of 2026, the consensus estimate is now calling for 24% earnings growth, and this would be the fastest growth since 2021. Revenue is expected to grow 11%, which would be the fastest since 2022, and a lot of this growth is due to the AI build-out. I mean, some of the earnings of these chip makers have just been absolutely ridiculous, and many analysts don't see it slowing down anytime soon and see corporations actually likely increasing AI-related capex. Not every asset has had a great year. Crypto has had a brutal first half with steep losses across most of the major names, including Bitcoin, Ethereum, and Solana. Long duration bonds underperformed meaningfully, as I mentioned in the fixed income section. China equities were relatively mixed and didn't participate in the broader EM rally the way that Taiwan and South Korea did. Defensive sectors like utilities and consumer staples underperformed the broader market as investors really leaned into risk. And the Magnificent Seven as a group, while they may have recovered strongly in Q2, they actually lagged in parts of the year as questions about AI capital expenditure, return on investment, really seemed to surface. The median year-end target for the S&P 500 among Wall Street banks and research firms is currently around 7850 according to Reuters and Yardeni Research. The S&P closed H1 at around 7440, so that implies around a 5% upside from here if these consensus plays out. Now that's not a massive call, and it's basically saying the second half looks a lot calmer and more moderate than the first half was. Some of the more bullish targets are meaningfully higher, with some analysts seeing the S&P breaking 8,000 by year's end, anchored to continued AI earnings beats in a soft inflation landing scenario. The more cautious targets are a lot closer to flat or slightly below current levels, so we'll just have to see how things play out. So what could derail the second half from repeating the success of the first half? There are definitely some real risks out there, so let's lay them out clearly. The Iran conflict is not resolved. Even with the Memorandum of Understanding having been signed some time ago, relations between the US and Iran are difficult. Any sustained re escalation in the conflict, and not these one off tit for tat attacks that we've seen multiple times now, would increase oil prices and feed directly back into the inflation problem. And speaking of, inflation is still running at over 4% year over year on CPI, which is well above the Fed's 2% target. And as I broke down in my last video, there's been significant movement in the rate expectations over this year. At the beginning of the year, it was seen as possible that we were going to get multiple rate cuts. Now it's very unlikely that we will see any rate cuts at all, and instead the likelihood of a rate hike has shot up. The first half of 2026 brought us a blowout 6 months. The Q2 numbers were as strong as anything we have seen since the post-COVID rebound. Earnings are delivering, the rally has broadened out from what it was in 2024, and small caps and EM are both performing strongly. That's it for today's video, guys. Let me know what your thoughts are in the comments. How did your portfolio perform in the first half? If you found this useful or interesting, drop a like on the video, subscribe to the channel, and check out my other videos. Thank you all for watching and for all the support on my recent videos. I will see you in the next one.